A record number of investors say the stock market is overvalued, according to a recent Bank of America Merrill Lynch survey. The poll found that 71% of participants believe the market is overvalued or extremely overvalued, up from 59% in January. This surge in pessimism can be attributed to several catalysts, including rising interest rates and inflation concerns. The Federal Reserve's decision to raise the benchmark interest rate by 0.25% in March has led to a decrease in investor confidence as higher borrowing costs make stocks less attractive. Furthermore, the ongoing trade tensions between the US and China have also contributed to market volatility. Data points from Bank of America Merrill Lynch's survey suggest that investors are becoming increasingly bearish on the market. The poll found that 54% of participants expect the S&P 500 to fall in the next 12 months, up from 34% in January. Additionally, the average target price for the index has decreased by over 10% since the start of the year. The chart below illustrates this trend. Asterisk, average target price for S&P 500, $2,625, down from $2,925 at the beginning of the year. Asterisk, short interest ratio in the S&P 500 has increased by 25% since January asterisk. The number of stocks with a buy rating has decreased to 34%, down from 43%. The scenario of a potential market correction is becoming more plausible as investors grow increasingly pessimistic. A correction would likely be triggered by a combination of factors, including rising interest rates, inflation concerns, and trade tensions. If this were to happen, it could lead to a significant decline in stock prices, potentially wiping out some of the gains made over the past few years. One potential risk is that investors may become too bearish, leading to a self-fulfilling prophecy. If investors continue to sell stocks based on their negative expectations, it could exacerbate market declines and create a vicious cycle. Another risk is that the economy may be stronger than expected, which would negate some of the concerns driving investor pessimism. A tactical idea for traders could be to look at levels around 2,800, 2,900 for the S&P 500 as potential support in case of a market correction. This range has been a key area of resistance and support multiple times over the past year. Another idea is to consider shorting some of the more expensive growth stocks that have driven the market's recent gains. The chart below illustrates the potential risk-reward ratio for traders. Asterisk. The S&P 500 has rallied by 20% since January, but its price-to-earnings (PE) ratio has increased by 15%. Asterisk. The average PE ratio of the S&P 500 is now at 18.5, up from 16.5 in January asterisk. The number of stocks with a buy rating has decreased to 34%, down from 43%. The takeaway from this data is that investors are increasingly wary of the stock market, with a record number believing it is overvalued.